Hello, welcome to the next edition of our series of podcasts. This one is on the Central London capital markets with the theme of uncertainty versus opportunity. My name's Ed Dunningham. I'm partner in charge of the commercial valuation team at Allsop. And with me I've got Nick Pemberton, partner in our West End team.
Hello.
And Chris Room, partner in our City team.
Hello.
Okay, welcome everybody. Just to set the scene a little bit, it's been a funny start to 2024. We're in a situation where interest rates have plateaued, and we believe, or we hope, that the next move will be down in terms of interest rates. But the problem, of course, is that inflation is pretty sticky. We've had some disappointing statistics over the last few months, and it's not coming down as quickly as we want. You've also got global concerns in terms of wars in the Middle East, in Ukraine, and of course election year here in the UK. So there's a number of other issues that are facing us. Should we kick off just in terms of the transactional volumes, which clearly this last year have been way down? And just perhaps, Nick, you'd like to kick off with your thoughts in terms of how much has actually been transacting over this last year or so.
Thanks, Ed. I'm well known for my geeky stats. So 2023, we're talking central London commercial real estate here. 2023 transacted, according to our numbers, around 6.75 billion, 6.75 billion, which is, starkly down. We can come into more detail about the city versus the West End, but 6.75 billion of volume. The 5-year average is about 11.5 billion of volume. And if we go back to the glory days, say 2017, between the West End and the city, it did 19 billion of volume. So we're kind of down, we're running at a third of the peak and kind of half the long-term average. I think that probably is similar to most global real estate numbers. Most markets seem to be down by those sort of numbers. But I think what will be interesting on this podcast is to drill in the differences between the West End and the city in a bit more detail.
So how does that compare to the city then, Chris?
Well, yeah, we're quite a bit down this year, certainly in terms of Q1. So we're at 302 million of volume for Q1 2024 across 18 transactions. Last year, I think actually we were fairly in line with the West End in terms of global figures. But that 302 million is over 90% down on the 10-year average. We're talking about volumes that are comparable to Q1 in 2009, Q1 or Q2 of 2020 when we were in the middle of COVID was around 240 million of volume. So we are the second lowest quarter volume that we've experienced since 1996, which is quite scary, really.
That is quite something, isn't it? And of course, last year one of the catchphrases in the market was this price discovery period. Do you think, are we through that now? Do you think we're out the other side, or is the market still adjusting?
I mean, my view on that, Ed, I think there's still a real lack of certainly larger transactions. I think when you say pricing discovery, we're seeing a lot happening. I mean, even with the 302 million of volume, there's still 18 transactions there for people to look to and point to that have happened in that period. Now, it's a low number, but because we're seeing a lot of smaller transactions, we are actually seeing transactions. But on the larger lot size, certainly in the city, and this is where Nick might have some to say because there's been some larger deals happening in the West End. But on the city, we've only had 8 deals over 100 million in the last 18 months. So since Q1 2023, there's only been 8 transactions, and 4 of those were in Q1 2023. So on the larger end of the spectrum, we really are, we are probably still in that price discovery, really trying to establish where people will pay for larger product. I think the West End might be a little bit different though, Nick.
Yeah, I think the long-term average lot size in the West End is about 60 million, unlike the city, which is probably a lot higher. But like the city, we've seen a real lack of your standard vanilla kind of multi-let office buildings, whether they're over or under 100 million. We've seen very few large transactions. Q1 2024 did 990 million of volume, roughly. The largest deal of that was a £200 million lot size British Land selling a half share to Royal London and Regent's Place. The intention of the parties there is to pursue life sciences strategy, so possibly not even really an office deal. That was the Meta former HQ. We have been looking at a couple of transactions in the West End really to try and point to market evidence for a standard deal. There's been 2 of those that have come through in the last quarter. 55 St James's Street, we saw Nomura buying that freehold multi-let office building built within the last 15 years. Good quality asset, and that's traded for around about 2,300 a foot, 4.25%. The adjoining building was sold 3 years ago for 3.25%. So I guess we've seen direct evidence of that yield shift moving from 3.25 at the peak to 4.25. The other thing that's changed, which is interesting about that deal, is passing rents are all about £115, £120 a foot, which was the case with the adjoining building a couple of years ago. But our ERVs on that building now are probably 150, 160, and that's kind of one of our favourite picks as a deal, buying a multi-let prime freehold St James's office building, modern, built in the last 15 years for 4.25% off what is reversionary rents. The other deal we've seen, a building in Bedford Street, where we saw go out to market at 4.25% and traded at 5.75%, 5.7%, and that is a pretty simple multi-let £75 million office building. And it's interesting now that we've got some evidence through, really, in answering your question in terms of, market rec rented stroke reversionary office deals. We're starting to see some evidence through.
I mean, there's clearly a few deals, aren't there? But what do you think will need to happen before, the turnover volumes really pick up properly?
In the West End, there's a weight of money wanting to invest. There are investors allocated money to the West End. It's not really the lack of buyers, and it's not really the lack of sellers. It's just a continuation of this period of price discovery where, you've got UK institutions selling. They've got the buildings valued at X and the buyers want to be paying Y, and there's still a gap between the two. So Bedford Street, an example in point, went out at 95 million, sold for 75 million. That's quite a big difference in pricing. I don't know what the building was valued at, but we need more of those transactions where the buyer and the seller kind of come together, really.
See, I think the city's slightly different. I think we're lacking stock that buyers that have money for the city want to actually buy. If we're asked, let's have a look at a prime, newly developed, multi-let freehold building, they're just not the type of buildings that are being put onto the market at the moment. If you look at the other end of the spectrum, where you've got buildings that need repositioning or redeveloping, the prices that, because of the cost of redevelopment and because of the cost of refurbishment, the rental level that we can get to in the city is not as high as the West End, and it just doesn't make sense. The pricing point that you get to in the end doesn't make sense for people to sell. So unless there's an element of distress there, or they have to sell, or perhaps the overseas owner doesn't have the appetite to go and develop the building themselves, then we're just not going to see that that liquidity of or transaction flow, I don't think, in the city. And I think that's probably one of the main reasons why we've suffered a little bit more in the city, is because of that. We can't quite hit the rents to then justify the the capex spend you need to spend on a building these days.
That's a really interesting point. But of course, we are seeing inflation in rents both in the West End and the city for the best space. The occupational markets appear pretty strong in terms of wanting to get back into the office and to take the best space. Where do you see that going over this year?
In terms of vacancy rates, I think the West End vacancy rate sits at 7%. But actually, if you look at grade A vacancy, it's kind of 1.1%. Again, it's the flight to the best quality offices, occupiers wanting the right ESG, or certainly the right E in ESG. And it's a flight to location. That's what we're seeing a lot of across the market. It's the better quality offices that are basically letting. I think we deal often with international investors, be they US based or Middle Eastern or Far Eastern. A lot of investors watch CNN and the New York story and the San Francisco story where people not returning to offices, etc. They're really surprised when they come to London and see, certainly 4 days out of 5, the West End and the city is busy. Most people are back in the office. And I think if you've got a committee making a decision based out of New York, they're going to be very anti-offices until they come to London and realise that actually, we're a sociable bunch and we all like being back in the office most of the time.
You certainly are. And in terms of the ESG you mentioned, how important is that nowadays? Is that something that, how far up the agenda is that in terms of an occupier's wish list?
I think it's really high up the agenda. It has to be. I think for a long time it was a tick box, but now, the bigger the company, the more they're judged on their ESG policies. And one of the big parts of the E, if you don't make anything and you're a service-based business, is your offices and how green they are. And even now, companies like Allsop, if we're going for government contracts, etc., we're often asked to be judged on our environmental policies and responsibilities, etc. And so companies now have to, in order to do business, companies are increasingly having to tackle the environmental piece and be in the best quality building they can be in order to do business. It's not a case of making it nice for everyone's colleagues. It's a case of needing it.
I suppose, to get the best EPC grades, you're talking either a new building or a properly refurbished building. And Chris, as you say, these things cost money until the rents make it worthwhile.
Yeah, I think it's interesting. There's a lot of groups now that are doing EPC plus reports, which, I hadn't heard of until about 6 months ago. And every sale now is, or certainly a sale of a building that's being or needs refurbishment or needs repositioning, is coming with an EPC plus report, which effectively gives you a breakdown of costs to get that building up to an EPC B and even an EPC A. I mean, we didn't have any EPC A buildings till 3 or 4 years ago, and they were all new developments. And now we're seeing some refurbished buildings that are achieving that EPC A. And I think, going back to Nick's point and the point you made, Ed, on the pre-let market and the strength of that, the city's exactly the same. I think occupiers are now almost putting, energy and ESG and EPC ratings at the top of their, they're filtering the viewing schedules by an EPC rating. So they won't go around a building if it's a C or below, because, it's just not up to the standard that they need to tick those boxes. So it's so relevant. I think we've known that for a while. There are different ways now that people are exploring those to help, sell buildings and lease them, I guess.
And just in terms of rental levels, the best rents now in the city, where are they pitching now? We've heard that sort of we're well past 100 quid in the West End. Where is the city sitting at the moment?
Yeah, I mean, the city varies. We've obviously got the tower cluster. I mean, the top rents in the towers are anything up to, £120 a foot, maybe even north of that on some floors in 22. I think for your sort of standard lower rise building in the city core at the moment with access to outdoor space, I think, a lot of people are targeting 80s into the 90s, perhaps if you're in that sort of Spitalfield zone and around Crossrail. I mean, the city has been going through this shift north for a while, and that's been driven by Crossrail, by the Elizabeth line. And I think, now we're seeing the higher rents really around, that Moorgate, Liverpool Street band. I mean, Farringdon is a different story because that's taken off even more. And, we've seen rents in Farringdon at, £110 per square foot plus, and that's catching up to areas a bit further west now. So, the rental tone has really motored on, but we are in this very much two-tiered market. We've got two buildings next to each other. One's refurbished to an ESG, high ESG standard, high EPC or EPC B+, might let it £60 a foot fitted, and then next door, they've not done quite as much job. It could be half the rent, and we've experienced that situation, up in submarkets like Old Street, Shoreditch, where even they're almost identical buildings, but because of the standard and quality of the space that's being delivered, the rent is half.
And I think we're finding in the West End in some cases that it's not a difference of half the rent, it's one will let and the other won't. It's corporates can't afford to take inferior quality buildings and attract people back to the office.
But how much did it, obviously these second-hand buildings, the inferior space, how much did it cost to bring a building back up to top quality nowadays? We've heard about building cost inflation and so on. Is it cost effective?
You're right to highlight it. One of the big challenges with offices still is the spend, is the refurb cost. I think it used to be you get a floor back and you put it in your cash flow at X to replace the carpet and do a little bit of work to it. But I think the pricing's been impacted on some of these multi-let buildings simply because you're spending a couple of £100 a foot when you get a floor back, or you're having to redo central plant. You could be spending £300-400 a foot. So I think one of the things that goes back to is location, because if you're going to fully refurbish a building, you might as well be doing it in a super prime location rather than a secondary location, because the cost of refurb is not that different.
In terms of pricing then, obviously these last sort of 6-9 months or so, the yields have generally been quite stable. But we saw a big correction from sort of mid-2022 to mid-2023, with the mini budgets and Liz Truss and the big spike in rates at that point. And of course, when you've got prime yields moving out by sort of 200 basis points plus, that's a huge change in value. And we're certainly seeing now some of the valuations in the city are sort of off 30, 40, 50% in some instances, and a few instances of receivership. What are investors making of that in terms of, obviously the value destruction on the one hand, but also opportunity there, surely?
Yeah, I think, as we said before, the buyer pool is still growing. It's increasing. There are more and more buyers coming back into the market for the reasons you said. I mean, we've seen a shift in prime yields, probably 150 to 175 basis points. And then, as we've discussed before, like the secondary sort of off-prime buildings have probably been a discount of 200 to 300 basis points. And then your tertiary buildings, I mean, there are buildings that you can buy in the city now with yields of 9-10%, some even higher, which we've not really seen since the last global financial crisis. But at the same time, the appetite for these buildings differs amongst buyers. We've got people that will be there to buy best in class location, as Nick was saying before, and they'd rather pay more for those quality of buildings. And then there are the buyers that are looking at this thinking, well, actually, these yields, we've not seen these yields before, and we could maybe buy something at, say 8-9%. In the city. It might not be the best street, but it's close to a major transport hub. The building fundamentals are quite good. And, we go in there, maybe we refurbish a floor, we do a fitted space on that floor, and, we can maintain that yield. And then over the period of time, we will see some modest yield compression. And that's how, I think people are looking at the city at the moment, and those deals that aren't best in class at a discount or in receivership or distressed, and they're seeing these buildings that are probably in the sort of core plus category where there's the opportunity to get, what we'd call sort of value add returns out of them by just picking them up for a higher yield, sustaining that yield, and then, underwriting a modest yield compression, which certainly IC boards don't like yield compression or the word yield compression used. But, I think when you're buying unit yields that are so high, there is a case for it. And we've seen a number of buyers in the city that are adopting that strategy, which is definitely an opportunity. And, as agents, we look at some of these things and we think, this is not a no-brainer, but, the risk is a lot lower to do a building like that, a core plus type strategy, than to go and take on a redevelopment or to take on a building that needs completely overhauling, because you've got, income in place.
It certainly seems that some of these city yields are at an all-time low for this part of the cycle. But in terms of other opportunities, repurposing, opportunities for change of use, hotels, residential?
Well, the city's seen a lot of it. The city of London itself as a borough has been very proactive in actually saying to landlords, look, if you've got buildings that are, vacant, sort of low energy ratings and, need a lot of money spending on them, we will consider that change of use. It's not really to permanent residential, but C1, so your serviced apartments and hotels have been the main focal point, and the availability of money for that sector certainly across Europe is pretty strong. So we had a small sale of a building on Cannon Street last summer, which went through. We had a load of interest, and it went way better than we could have expected because of that C1 use and that planning consent. But since then, 35% of transactions in the city over 20 million have been for a change of use. So they've been office to hotel to co-living to student. And our largest deal this quarter was Dominus's acquisition of 65 Fleet Street, so the old Freshfield HQ, which is a 240,000 square foot building which they've acquired to convert into high-end student accommodation. So, we wouldn't be saying those words 12 months ago because it just wouldn't have been possible with the planners.
Yeah, an amazing change. And Chris, we'll let you draw breath, but coming back to Nick, West End doesn't have so many opportunities in terms of repurposing, but the value change hasn't been quite so marked either. But
it sort of hasn't, but in being slightly mathematically geeky about it, if you're moving from a yield of 3.25 to 4.25, that's a pretty big shift in value anyway, but, in actual value terms. I think it's true that the city and the city corporation have really seen the opportunity from offices to beds, and it probably says quite a lot about the sentiment towards offices as it does towards sentiment towards beds, I suppose, in the city. West End, obviously a lot less so, but the biggest deal of the quarter, Q1, is is, as I mentioned earlier, British Land selling a half share of the former Meta HQ offices, where the new JV with Royal London is to pursue life sciences. So it's up close to Euston, etc., in that sort of Knowledge Quarter area. So actually some of the bigger deals that are happening, you look at last year at Criterion Capital buying Haymarket House. Again, that's to pursue a beds scheme. So some of the biggest deals in the West End also have been office to beds, really, I suppose, or office to life sciences. And I think we're seeing it everywhere. If there's opportunity to change use and have mixed use buildings, then they're probably getting a wider base of investors to look at it.
And whilst we're on the subject of some of these further flung locations, peripheral spots such as maybe King's Cross and Paddington and some of these newer office locations, how's the market faring in those?
I think pretty strong for the likes of King's Cross and for the likes of Paddington, obviously anything along a Crossrail. Chris mentioned Farringdon earlier, which certainly from a pricing perspective and a rent perspective is seeming to adopt as part of the West End rather than part of the city. I think the challenges come with maybe some of the Hammersmith markets where change of use is not as straightforward and pricing really has to come off significantly because there's a very limited office demand for a lot of these assets, and probably still remains quite a challenging planning environment. But we are starting to see some of these transactions go through where people, I suppose, are almost land banking some of this office space in the Hammersmiths of the world, where values have certainly halved, let's say, on certain assets, just because the view is that at some point planning will change and it's starting to represent good value.
That's interesting. And Chris, I mean, presumably a similar story for a place like Canary Wharf and some of the further flung eastern territories.
I knew you were going to ask me about Canary Wharf. Yeah, I mean, Canary Wharf has suffered, and ironically, it's been the place that's probably benefited the most from Crossrail, from the Elizabeth Line connection. You can now get from Moorgate to Canary Wharf in about 10 minutes and Bond Street in 20. So, the connections down there now are phenomenal. But I think, you're absolutely right. The office space down there has suffered. There's always been a lot of back office space, subletting space. And, when you've got large organisations in very big buildings that are trying to reduce their footprint, we've still got a little bit of a lag from COVID where not everybody is in the office 5 days a week. And, places like Canary Wharf have suffered. I think the city, funnily enough, is benefiting from Canary Wharf suffering because, for example, HSBC, we all know about moving to Panorama near St Paul's is a great for the city, but not so great for Canary Wharf. But then again, we've seen, Morgan Stanley have committed to a new lease down there, which is good. I think Canary Wharf themselves have been really proactive, not just themselves, but in the press as well, quite openly about how they're willing to work with landlords to try and change. We're always very fixated in the UK on having office in one building, resi in the other, and life science in another. But I think they're going to become a little bit more creative about the way these spaces will be used, and you may end up with buildings having part this, part that, and to try and invigorate the environment down there. It's still a very, very busy place, Canary Wharf, and you go down there on a Wednesday or Thursday late afternoon or even lunchtime, there are lots and lots of people walking around down there. For me, I think the areas around Crossrail Station, the Jubilee Line, the North Colonnade and South Colonnade are still very good places to invest, good places for occupiers. I think the problem is that the wharf is not just there, it extends down to the Docklands and it goes out to Westbury, and there are some buildings that will become quite troubled down there. But it's still a living, breathing submarket. I
think probably one of your issues in Canary Wharf as well is the lot size. You're probably dealing in big buildings generally, and that's where we've had quite a sticky market for the larger lot sizes.
And one of the great saviours, they say, are life science. They're obviously promoting it quite heavily down there, but also in the West End and particularly around King's Cross. Is that a market that's still got legs?
I think life sciences is probably a market. I'll put my hand up and say it's not a market I think I understand that well. What I do know is that for 20 years as agents, we've all been putting Crossrail down on our sales brochures, and now it's finished. We're all putting down life sciences, Knowledge Quarter, life science hub, proximity to Oxford, Cambridge, etc. And I think agents are putting that onto their brochures, be it even in Canary Wharf or wherever. And it's still, a lot of the life sciences market is probably still to be tested. I'm certainly not the right person to be talking in any detail about it, but it'll be interesting, schemes like Regent's Place, but right through to King's Cross. As far as I know, the closer you are to the crick, the better chance you have of doing life sciences. So
Yeah, and I think as well it comes back to that argument about rents. What rents can you achieve? We know King's Cross as an office market has got rents of, I'm looking at you, Nick, but like 80, 90 pounds a foot plus sort of thing. And when you go down to Canary Wharf and you look at office rents and Whitechapel, which they've tried, and it might still come good, but there's not many life science schemes that have taken off yet in Whitechapel, where office rents are 50 to 60 probably at best. So, and you've still got to spend a huge amount of money, a lot more money, on creating the lab space. So I think that's going to be the trade. That's why King's Cross, I think, has been so successful, is it's bred upon the critical mass you've got there anyway, but also the rental tone is a lot higher.
It's fascinating, isn't it? And of course, I suppose across the board we're seeing strong occupational markets, growth in rents, which is coming through, but of course in the background, a change in the investment market that we saw, most of the change happened over 12 months ago, but it's taken so long to feed through and for the market to really understand it and digest it. So we're in this sort of point of stability, but it hasn't really picked up, and it hasn't really, in some respects you could look at it and think, well, we're at the bottom of the cycle. In fact, some of our investment team across Allsop were calling the bottom of the market back at Christmas, maybe just before Christmas. And yet we're here in a position, charging through 2024, and the market is still slow, still...
Is this where we blame the valuers, Nick?
I think you can turn on... every time I turn on the TV to watch the news, I sort of feel like I want to put my finger in my ears of the geopolitical stuff that's going on at the moment. In some ways, what we're lacking in terms of deal volume is the bigger transactions, the long-haul investors who, international investors who are travelling over to buy 2, 3, 4, 500 million pound buildings to bolster the stats. We're back up to 11 or 12 billion a year in London rather than the sort of 6 or 7. It's making the market in a way in London seem worse than it is. The number of transactions actually is not down. It's certainly number of transactions is not half. It's just the volume. It's the bigger deals that are not bolstering the numbers. And if you look at the fundamentals in the London market, you've got a lot of demand for product. You've got really good opportunity as a private investor to buy an asset where you might be in competition with 1 or 2 other people, whereas historically you might have been in competition with 10 other people and 4 of them might have been funds who would be in pole position. So it's quite an interesting opportunity.
You're right. We had, I think we worked out around 35 deals over 100 million in the city in 2017. Yeah. And we've had 8 in the last 18 months. Yeah. So imagine what that does to the volume and just confidence, really, I think, from overseas, and it is the Asian market particularly that props up, our volume. That's where a lot of the money is. So it's made a massive impact. And
I think going back to offices as well, if you look at the West End deals that are bigger, a lot of them have been Bond Street retail or office to hotel, or, it's the office sector specifically that's kind of probably off more than the total.
But what do we need to get going, though? Some people are saying, well, we need to see that interest rate start to come down. Yeah. And, the inflation figure we've said before is a bit sticky, and there's some good stats and bad stats, and it feels like 2 step forward, 1 step back. Do we really need to see that interest rate start to fall before people really dive in, or is there more to it than that?
I think that's part of it. I think when that does happen, we've already got quite a few investors that will be known to everybody that will be coming over from Asia, funnily enough, over the next 6 to 8 weeks, which is interesting because they haven't really been coming over as much in the last sort of 6 to 9 months. So I think this is a catalyst for people to start looking again at buildings. But I think until that pivotal actual, right, this is what's going to happen and it's going to move down again, actually happens, I think we'll still be a little bit constrained. I think in the city, as I said before, we've just not got the sellers of that product either. The product that the Asian investors want, that prop up these 100, 200 million pound lot sizes, best in class buildings, we just don't have that product out there that wants to be sold at the moment. It seems easier for owners of those buildings to actually kick the can down the road and refinance short term than to actually crystallise a sale at a significant loss. I think that's part of the reason.
I suppose the other reason is probably the bank's attitude to the market at the moment. On the one side, they're certainly nervous in terms of some of these second-hand buildings, particularly in the city, where the values have come off and there's pressure building to sell some of these. And of course, we've seen some high-level receiverships. But, from our perspective on the valuation side, we've certainly been very busy valuing, loan reviews, refinancing, but not a great deal of new lending. And the one thing that probably in the last month or two that we are seeing now are banks preparing themselves to lend, setting new targets for the year, for the financial year, and starting to gear up to lend money. So, let's see how that develops. But it does feel like a little bit of a sea change in terms of attitude there.
Yeah, well, that's one of the big catalysts for the market moving, isn't it? But I think we came into the new year feeling that interest rates were on a certain trajectory, and then if you look at sort of gilt yields, etc., they've sort of fluctuated more than we would kind of have hoped them to. So I think there was a widely held view that as soon as we know where rates are going, then everyone's going to not necessarily pile in, but we're going to see a lot of investors coming back to the market. And I think it's probably been a bit less certain than we perhaps thought it was going to be in terms of rates.
Okay, let's just think of where the opportunities are now then, and perhaps, if we kick off with the West End, are there any particular examples that you want to draw upon?
Thanks, Ed. Yeah, I think if you're a private investor and let's say you're wanting to invest 10 to 50 million, let's say, go back 5 years and you were competing with all the UK institutions, you would go to best bids and you'd have a dozen bids on a typical sort of freehold West End asset. And where the real opportunity lies, I think, at the moment is, let's say you're an overseas investor and it's your first or your second transaction, you're now competing against one, maybe two other people. And whereas before the agent would usually pick someone who had an investment committee and they would wave the deal through, now we'd rather be talking to the actual individual decision making rather than that person having to go to committee and it, being turned down at committee. So I think the real opportunity in the West End is in adding to your portfolio or buying an asset. You might not be at the bottom of the market, but you're certainly sort of feels like you're close to it for the sort of prime assets because they're bolstered by the rental growth. So to me, the opportunity at the moment is in it not being a crowded market.
Yeah, it certainly makes it easier, doesn't it, for buyers that are in there. And Chris, what do you think in terms of the city?
Yeah, I mean, I think, the same logic goes. You are competing with a lot less buyers generally, or whatever asset class you choose. I think for the city, because we have seen such an outward movement in yield, I think, if there are buildings which offer income, and these are rare, but north of 10 years. I mean, there was the building on Fetter Lane, which was let to Bird and Bird for 13 years, and I think if you can acquire those, I think that was acquired for a purchase price of around 5.75%. But you've then got a buffer of probably 2 to 3 years, and that building has still got a WALT of over 10 years in 2 to 3 years' time. I think there's an amazing opportunity to acquire longer income for a much wider spread of yield than you would have done previously. I think the other interesting thing is there's obviously a lot of alternative sector money looking in the city at the moment. Hotel market is competitive. There's a lot of co-living and residential operators, PSBA operators looking and trying to pick off these buildings in the city. But there are boroughs that have buildings in the city, Islington, Hackney, Tower Hamlets, who are less receptive to that change of use, where you can buy a very good quality office building in the core. An example again would be something like a Finsbury Dials, which ended up going through a receivership process, but acquiring that at a low capital value per square foot and then delivering that product into a strongest pre-let market we've had in decades really in the city is an interesting opportunity. And smaller buildings as well, smaller VP plays where you're buying a building for VP values that we just haven't seen since probably pre-2012 in the city. We're talking about VP values in the sort of £300 per square foot, which, and it's more expensive to develop now, but you're getting higher rents. So it all transacts through. But that market used to be very, very, very strong, and people would be paying £800 per square foot for vacant possession buildings, and now it's moved off a lot. So I think that there are a number of opportunities, but it's as I do like Nick's analogy of location is so important, and you want to make sure you're buying in the right spot.
Well, certainly location doesn't change, but the pricing clearly has, and it certainly seems there are opportunities there. It's a question of, do you dive in now and take them, or wait till things get busier, and that's always a difficult question to pose.
Well, it is. I mean, everyone wants to try and call the bottom of a market, and it's always really hard to do. And you'll often find that people tend to sort of slightly miss it and only notice it's the bottom of the market when it's on its way back up again. And then suddenly you're competing with 7 other people rather than 2 other people, and the pricing moves. When the pricing moves, it moves quite quickly. So in our market in the West End, that's going to be buoyed by rental growth. as much as sort of views on yields, to be honest.
So to round off, Nick, perhaps you'd just like to give us your thoughts in terms of your favourite deals at the moment.
Yeah, I think going back to the point about competing against one or two other people rather than 10 or 12, deals that I really liked in the last 12 months, buying a collection of buildings on pretty much one side of South Molton Street. You've got the Crossrail coming through, you've got Grosvenor and Mitsui developing on the other side of the street, and to buy a collection of buildings with 50 tenants for a yield in the fours and sort of in the 60 million territory, I think it was 62 mil. That's a really interesting building. That's the set of buildings that you're not going to see come to market very often, kind of thing. So that was an interesting deal. I also like the St James's Street deal. You're buying a building that's under 15 years old. It's a freehold. You're going to see some terrific performance in the rents if you do the right sort of refurbishment and repositioning of it. So those sort of buildings, they're hard to buy, and I think that's quite an interesting time. The other thing I kind of want to just touch on is that we sit in our kind of London market slightly blinkered by, volume 6.3 billion, and it was 19 at the peak, and it's normally 11, 12. But actually, this is what's happening globally, and actually, in many ways, London is still regarded as one of the best, if not the best, capital city in the world. And you talk to international investors, and there's a real depth of liquidity there, because you talk to any international investors and they'll say, oh yeah, we're quite interested in London and in Paris and in a couple of other cities. But really, London is the first place most investors will go to invest outside their home, effectively.
Yeah, I think that's it, and I think that's why we're being driven by the private markets at the moment. It's private X, Y, and Z from various countries who might be their first or second acquisitions, but it's in London, and I think we can be buoyed by that, and we can be buoyed by how busy it is on the streets now, and COVID is a distant memory, hopefully, for most people. It certainly feels like it when I get on the train in the morning anyway. So
we nearly got all the way through without mentioning the C word. It's like years ago when you used to try and get through an entire meeting without discussing Brexit. You used to get about a minute in, but...
mentioned as a distant memory.
Ed, I've got a question for you, really. We've talked quite a lot about the pricing disparity between buyers and sellers, and where does the valuation sort of sit within that argument?
It's a really good question. I think we've certainly been exceedingly busy this last year, and as I've mentioned, a lot of loan security work for sure, reviews and refinancing. And I suppose value is always a challenge when the number of transactions reduces, because there's less guidance out there in terms of the market. I think we're very blessed at Allsop. We live and breathe transactions. We probably do more than most in terms of firms of our size. So we are very blessed in terms of market knowledge and lots of agents, lots of buyers and sellers that we're talking to all the time, and give us the confidence to price buildings and put our names to valuation reports. So it's been interesting. It makes it fun when market changes. At the moment, the market is stable, but at an interesting point where we think things will pick up. Good. Well, should we wrap it up there? It's been a useful conversation. And if anybody out there is interested in getting in touch, it's Nick Pemberton, Chris Room, Ed Dunningham, and we'll wrap it up there.